How's it going, everyone? Welcome to the next episode of the Pip Catcher's Mentorship for the Pip Catcher Expeditions. In this episode, I'm going to be showing you guys the model that you guys will be using for your guys' trade entries. Now, this model is called the ICT 2022 model. This model was created by the Inner Circle Trader in his 2022 mentorship. It is free to watch on YouTube if you guys best see fit, when you guys want to watch it or how you want to watch it. It is long, which is why I do have this mentorship for you guys. So it is easier for you guys to learn, and it is faster for you guys to learn as well. So this ICT 2022 model is one of the easiest, if not the most easiest model to use in trading with smart money concepts, okay? So ICT 2022 model involves technically 3 steps but to be more specific, is going to be 5 steps for this one that I'm teaching you guys, okay? So technically it's 3 steps, which is going to be a sweep of liquidity, market structure, shift, fair value gap. But this is going to be more specific about what to do, okay? Now, the ICT 2022 model will go like this. The first step is you're going to want to identify external liquidity points. Remember, your buy side and sell side. Now, this can be found on the 1 hour or the 15-minute time frame. The next step is you're going to wait for liquidity to be purged or swept. So a liquidity sweep, right? And this will happen on the 15-minute time frame. Next, you will identify a market structure shift with displacement. And this will be on the 15-minute time frame or the 5-minute time frame. And then finally, you're going to find a fair value gap in the leg of price that caused the market structure shift. And then finally, you're going to be entering on the fair value gap. And then for a bonus one, which makes it extra high probability, you can use premium and discount array for entries. So remember, buy in discount, sell in premium. Okay. So first off, we're going to do the first step, which is identify external liquidity, which is buy side and sell side, either on the 1 hour or the 15 minutes. So we're going to do the 1 hour. So when we look at this leg of price, you guys may think, okay, the range is looking at it like this, right? This looks like what the range would be. From this low to this high. That's what the range looks like it could be, right? What I want to teach you guys is this. Every time a higher time frame PD array is mitigated, that creates a new range, okay? So you see how we traded from this low to this high. The market traded back down into this fair value gap and then rejected higher. This is the new low for this whole range now, okay? This new low is for the whole range now. So now, our new trading range is from this low to this high, okay? That'll be our new trading range on the 1 hour. So what we can identify is that our buy side liquidity would be here. This would be our buy side liquidity. And our sell side liquidity would be here. This would be our sell side liquidity, okay? So the first step is finished. We marked out our buy side and our sell side liquidity points. So we got our buy side here, and then we got our sell side here, okay? So we marked that out. Step number 1 done. Next, we're going to wait for liquidity to be purged, which is going to be on the 15-minute. So let's drop down to the 15-minute time frame, and let's wait for liquidity to be purged on the 15-minute time frame. So that means we want to see a liquidity sweep. We want to either see a sweep here at buy side or a sweep here on sell side. So let's wait here. So playing it out in time, boom, liquidity sweep right here. Okay. So once we got that sweep of liquidity, we swept buy side liquidity. So this buy side has been swept because we have a liquidity sweep here. Remember, failed displacement over the highs. That's a sweep of liquidity there. Next, we want to identify a market structure shift with displacement, and this can be either on the 15-minute or the 5-minute time frame. Now, on the 15-minute, we can't really see any detail inside the candle, so we'll go down to the 5-minute time frame. So boom, here we have our market structure shift right here. Okay, so this is the first break of market structure with displacement, which will be identified as our market structure shift. So this is our market structure shift. Okay. Finally, we want to find a fair value gap in the leg of price that caused the market structure shift, and then we're going to enter on the fair value gap. So we can fix this by using the 5-minute, 3-minute, or 1 minute. Okay? One of those 3 time frames. Alright? So in that, one of these 3 time frames, we're going to find a fair value gap in this trading range. And a bonus one, we can use premium or discount for this, okay? So if we pull out our Fibonacci retracement tool, right? Pulling it out from there. Or we can do it from high to low. Let's do it from high to low, actually. This will be our trading range. We're going to want to find a fair value gap inside of premium, right? Inside of premium, okay? So with this, we will use this for our entry, okay? So with our entry point, we're going to use a fair value gap that's going to be in premium for our entry. And this can be either on the 5 minute, 3 minute, or the 1 minute, okay? So those are going to be the three of the steps that are going to be for our entry point, okay? So that'll be for our entry. Now, we identify that there's a fair value gap here, right? This is a pretty big gap though. So let's see if there's any smaller gaps that we can use, okay? So we do have a SIBI, remember, SIBI, sell side imbalance, buy side inefficiency, identified right here. We can use this for entry point right here. If we come down to the 3 minute, we can identify that there's a bigger gap in this range. And then the 1 minute, we can see that there's an even bigger gap. So right now, if we come on the 5 minute, right, if we use the 5 minute time frame right here, this would be the gap that we want to enter on, right? So, remember our steps, right? Find a fair value gap in the leg of price that caused the market structure shift. That would be this fair value gap. This would be the leg of price. This would be the gap right here. And we want to enter on the fair value gap, okay? So, this gap is identifiable. It is pretty big, but what we would do is we would enter on either the open of the gap or we would enter at consequent encroachment of the gap. One of the two. So, let's just use consequent encroachment of the gap for now, okay? And you always want to have your stops above the most recent short-term high or swing high, basically, that it made. This is a pretty fat one, and then you always want to target at least a 1 to 2 risk to reward ratio, okay? Minimum 1 to 2, okay? In that, you can at least target a 1 to 2 risk to reward ratio, or you can target the next point of liquidity, which would be sell side. So let's do that, okay? So if we let this trade play out here, we can let it play out here, and if we tap into here, okay, boom, tapped into the trade here. If we entered for a trade here, have our stop loss right above the high, and then we can let the trade play out. Trading back down now. Now that we broke past here, we can identify that it could trade lower back down to sell side, having our TP right at sell side liquidity point. Boom, hits our take profit right there. Okay, so simple as that. That's how the 2022 model will work. So that's our first trade. Okay, now we can identify that we hit sell side liquidity. So let's see if we get a sweep of sell side here. So remember, sell side, sweep of it on the 15 or the 1 hour time frame. Okay. Do we get failed displacement here? Yes, we do. So let's see if we get our market structure shift. So we got our sweep of liquidity here on the sell side. So let's look at the sell side here. Turns into a sweep of liquidity here. Let's see if we get our market structure shift on the 5 minute. So if we can get displacement over this high, this would be our market structure shift here. Boom, displacement right there. So, right there. So remember, identify external liquidity, buy side and sell side. Buy side got swept, sell side got swept here on the 1 hour or the 15 minute. Wait for liquidity to be purged on the 15 minute. We did get a sweep of liquidity here, okay? Identify market structure shift with displacement on the 15 minute or the 5 minute time frame. So let's wait for the 5 minute. Did we get our sweep of liquidity? Yes. Did we get our market structure shift? Yes. We got it right here. A shift here, we got displacement over both of these highs. So technically, it would be this high that it had shift over, okay? But let's just look at it like this. This would be our shift in market structure right here, okay? Next step, is going to be identifying the fair value gap that caused the market structure shift, which would be this leg of price here. So did we get a fair value gap on the 5 minute or the 3 minute or the 1 minute? So let's look at the 3 minute. We do have a fair value gap here. And then the 1 minute. Then we do have 2 fair value gaps here. Okay, so let's try to create a fair value gap on the 5 minute. Boom, we create one on the 5 minute. But let's pay attention to this 3 minute one because it is smaller and we can decrease our risk in that sense. Okay, so this is our entry here, 3 minute fair value gap. That's what we'll be entering on right there. Okay, so what we can do is we can have our stops below this low, and then we can trade up to the most recent swing high, which would be this buy side liquidity or this buy side liquidity here. Okay, so let's mark out this buy side here. Okay, so buy side liquidity here, and we can target this for our take profit. Okay, and we can decrease our risk by, instead of taking it our stop loss between below the swing low, we can trade it below this short-term low here. Okay, so we can have our stop loss here, having a quick 1 to 2 risk to reward ratio. Okay, so if we trade back down into here, and missed our entry. Okay, so we did miss this entry opportunity, but what we did have the opportunity to do is actually find ourselves tapping into buy side liquidity here. Okay, so once we tapped into here, we do have failed displacement here, so this will be purging liquidity here. On the 15 minute, this is purging liquidity right here. We are trading higher, and as you can see, we are heading up even higher now, tapping into potentially this fair value gap for a continuation lower. Let's see if we tap into it. We do get a mitigation here, and let's see if we trade lower. We start to trade lower now. Okay, so and this is not the 2022 model, this is a whole different model, but we're paying attention to is the 2022 model. So again, this is the 2022 model. Okay, identifying external liquidity, buy side liquidity and sell side on the 1 hour, the 15 minute, waiting for liquidity to be purged on the 15 minute, which is a liquidity sweep, identifying a market structure shift with displacement on the 15 minute or the 5 minute, and then finding a fair value gap in the leg of price that caused the market structure shift, and then entering on that fair value gap, which would be a 5 minute gap, 3 minute gap, or 1 minute gap, and then using premium and discount will give you extra higher probability. So this right here is a great example of the 2022 model. Trading up into it, having stops above this high, targeting sell side liquidity perfectly. Okay, so this is a perfect example of the 2022 model right here. Okay, so, and just to even be a little bit more specific for you guys as well, shift in market structure, sweep of liquidity, mitigation for fair value gap, and then obviously targeting sell side. Okay, so all of those things. Okay, so this is the model that I do recommend you guys start to implement into you guys' trading charts. You guys can back test this, you guys can tape read this, and you can find multiple 2022 models on every single session. And I am telling you guys, this model is very high probability and is one of the most simple and easiest models to use. Other than that, I hope you guys found this video useful, and I hope you guys took down notes, and make sure you guys read over those notes over and over again, because without those notes, you guys are going into the live markets clueless. I hope you guys had found this very insightful, and I'll talk to you guys later.